In a massive 1.1 million square foot warehouse located in Fort Worth, Texas, companies are preparing for the possibility of hefty tariffs on imports from China, Mexico, and Canada. This warehouse is filled with millions of dollars worth of goods as businesses scramble to stockpile ahead of potential trade barriers. With tariffs looming, companies are adopting a strategy known as front-loading, which involves purchasing and storing goods in advance to avoid increased costs when the tariffs hit. The US economy is highly import-dependent, especially on goods from Southeast Asia and China. So when tariffs are imposed, these goods become significantly more expensive, impacting everything from electronics to clothing. Major retailers like Walmart and Columbia Sportswear are already feeling the effects, increasing their imports from China to avoid tariffs. In fact, Walmart's imports from China grew by 33% between 2023 and 2024, while Columbia Sportswear saw a 50% rise. Other sectors like infrastructure and technology are also affected, with products ranging from solar panels to AI server racks being shipped in larger quantities. However, front-loading isn't an option for all companies. Large corporations have the infrastructure, massive distribution centers, and strong shipping networks that enable them to adjust to these changes with relative ease. Smaller companies, though, struggle to keep up, especially with added storage costs. At its logistics in Fort Worth, this surge in stockpiled goods has brought new business opportunities. They not only handle transportation but also storage, which adds extra costs that are often passed down to consumers. The increased cost of tariffs isn't just a problem for businesses. Consumers will also feel the impact. As companies pass on the higher costs of tariffs, everyday products, from food to electronics, are set to become more expensive. Footwear, a major import product from China, is one of the most affected sectors. Companies like Deer Stags, which imports a large quantity of shoes from China, are worried about the rising tariffs, particularly with footwear duties increasing to as much as 16%. This situation is made even more complicated by the unpredictability of tariffs, as companies struggle to plan for future price hikes that might not have been anticipated when orders were placed. For smaller businesses like Deer Stags, which lack the financial muscle of retail giants, the ability to front-load products is limited. They simply don't have the storage space or capital to make these large-scale adjustments. Moreover, tariffs on goods imported from Mexico are also a huge concern, particularly for industries like automotive manufacturing. In fact, Mexico is the U.S. largest trading partner, and tariffs could disrupt the smooth flow of goods across the border, potentially driving up costs for manufacturers and consumers alike. If new tariffs on Mexican goods come into effect, U.S. companies, especially those in the auto industry, could face severe consequences, with some estimating job losses in the hundreds of thousands. The broader implications of tariffs are also visible in the flow of resources from Canada, which is a major supplier of petroleum, minerals for electric vehicle production, and chlorine. Any disruptions in the supply of these essential goods could have significant knock-on effects across multiple industries. Ultimately, tariffs are a cost that everyone will have to bear: companies, consumers, and even the economies involved. Businesses are grappling with how to manage this uncertainty, with some opting to front-load inventory to mitigate potential price hikes. But with retaliatory tariffs looming from China, Mexico, and other countries, the full impact of these trade barriers is still unclear. As a business owner or consumer, it's important to understand that these increased costs aren't just theoretical. They will be felt in your everyday purchases. Whether you're buying food, electronics, or even clothing, these tariffs could increase prices across the board.